basically we are left with capital gain tax and withholding tax, which are for just 10 marks. Capital gain tax is for 10 marks. Then withholding tax is also for 10 marks. Then maybe we'll do some small briefing on tax planning, even though tax planning is not in principles of taxation syllabus. It is an advanced taxation syllabus for 15 marks. It's not in principles of taxation syllabus, but I'll do small briefing on it and then we'll end the class. So our previous meeting, we solved up to question 16. We've done question 16, which is on business income tax, and question 17, I think we should try, that was just yesterday, so I said we should try our hands on question 17. Then today, if there is any difficulty about question 17, we will do justice to that before we start with capital gain tax, and we'll do something on withholding tax as well. So have you guys tried question 17? Have anybody tried question 17? And I've added by saying that this question is the pilot question for advanced taxation candidates. It's not for principles of taxation. Principles of taxation, they can equally give you this question because whatever we have learned, whatever is in the syllabus for principles of taxation and business income tax, the same thing that is we have for advanced taxation too. So they can equally give you this question, just that this question is too loaded for principles of taxation candidates. But the principles that you are going to use to solve these questions are not different. The principles are the same. Mind you, this is taxation. So we are all learning the same principle. All right. So if you like, if you have, I don't know if you guys have a problem, have a challenge with it. Is anybody having a challenge with, or nobody tried it? Nobody tried the question 17. Or nobody, somebody tried the question 17. Now, Derek, have you tried question 17?
Sir, please, no.
No, okay. So what's the suggestion? Should we solve it or?
Sir, please, let's go through so that it will be revision for everybody.
Okay, all right. So the requirement of the question is you have to compute capital allowance claimable by Kinata Company Limited for the year ended 31 December 2023. You have to show all workings. The second requirement is you have to compute chargeable income and tax payable by the company. So I'll be saying it in every exam, every question, read the requirement first, know what you are supposed to do before you start reading the question. All right, so let's go read the question together. So Kinata Company is a manufacturer of pomade and perfumes. So this company is a manufacturing company. Mr. Philip, you're welcome.
Thank you.
Right, did you try question 17? I believe no.
No.
All right, so we want to just go through it. I will not solve it. I'll just explain the treatment of the items. Then you go and solve it. All right. So the company, Kinata Company Limited, is a manufacturing company. So that should tell you the tax implication of the type of business. Now, the company started operations on 30th September 2022. So take note of the days of commencement of the business. Preparing account to 31 December each year. So this should tell you that for capital allowance sake, for the 2022 year of assessment, it will not be full year. It will be the year the company starts to operate. So from 30th September 2022 up to 31st December 2022, how many days will be that? How many days will be in the basis period for Kinata Company Limited for the 2022 year of assessment. How many days will be that? How many days would that be? So ending of September. So just October to December. So that will be, is that 92 days? Would that give you 92 days? October have 31, November have 30, then December have 31. So that will give you 92.
92.
Yes.
Yes.
So it means for capital allowance purpose for 2022 year, the number of days in the basis period will be 92 years. Your C, A by B by C divided by 365. Your C will be 92. Now, this company is a manufacturing company. We were not told where the company is located. So the tax rate will be 25%. So your tax rate will be 25%. Now, the company recorded a net profit of 10,575,000 Ghana cedis for the year ended 31 December 2023. After considering the following transactions. So 2023, they make net profit over 10.575 million after considering the following information. So the first information, net interest received on bank account, 50,140 Ghana cedis. They receive net interest on bank account. Now, we know when you are determining the accessible income for a company or for a taxable person, the accessible income must be determined separately from each three sources, from employment, business, and investment. But this one, the net interest they receive amount, this amount is not an investment income. The interest is on their bank account, the normal business account, the normal bank account they have for the business. They receive interest on it. That interest is not an investment interest. So it must be added. So you have to add it to your income and tax. Now, this interest is net. We are told that it's net. Somebody is giving us feedback. Who is that? Yeah, Mr. Philip, there is some noise coming from your background.
I don't know. My phone is. What's wrong with this phone? Is this still coming?
It's better now. It's better now. Now, we know that interest will be subject to 8% withholding tax on account. 8% withholding tax on account. So it means that they've taken the 8% tax out and they give them the net. So you have to gross it. You have to gross it. Now, how do you gross this amount? How do you gross it? It means that they have added this amount to, instead of them adding the gross, they've added the net. So the gross will be 50 and 140 divided by 0.92. Whatever you get, take this value out of it. That is the excess, that will be the tax component which must be added. I don't know if you guys are getting my explanation. The interest on the bank account, I'm saying that this interest, the gross amount must be added to the income of Kinata Company Limited. But they added only the net. So get the gross amount, find the difference between the gross amount and the net. The excess amount, add it to their income while you are determining their chargeable income for the year. All right. Trademark. There's a note on the trademark, note 1. We will read the note. Donations, there's a note on it. Depreciation, excluded expenditure, you add it back. Marketing cost, you allow the marketing cost. General cost, there's a note on the general cost. You read the note. Rental expense. Rental expense. Rental expense, you know, it's an allowable deduction. Canteen expenses. Canteen expenses. Canteen expenses is an allowable deduction. You allow it. Interest paid. There's a note on the interest paid. You allow other expenses. There's a note on the other expenses. We will read the note. Now let's read the note 1. Note 1 is on the trademark. The company registered a trademark for one of its PUMID during 2023 year of assessment. Gold fresh at a total cost of 150,000 Ghana cedis. So the cost of the trademark is 150,000. The trademark will expire in the next 10 years. The market research expense on the pomade is 130,000. So 130 plus 150, that gives you the 280,000 Ghana cedis. Now, the trademark, we know, is an intangible asset, which must be capitalized and capital allowance will be given to them. But they expense it. They have deducted all the 280. So it means that we have to what? Add the 150 back, which relate to the trademark. We add the 150 back to their income before we get their chargeable income. The research will be expensed. I asked this question the last time. Research expenses is an allowable deduction. So the research will be expensed. So that one is in place. The trademark will be disallowed. They have deducted it before they get the net profit of 10,575,000 Ghana cedis. So we will disallow the trademark, capitalize it, and give the capital allowance. Donation. The donation was in respect of a borehole built for the company, for a community as corporate social responsibility. This was confirmed by Ministry of Local Government Service. So this is an allowable deduction. So it means that the donation will be allowed. They have done that, they have deducted that, and that is in place. The general costs include 140,000 incurred in creating retaining walls around the office building to strengthen its foundations against sinking. The total general cost is 700,000. Now, out of the 700,000, 140,000 was incurred in creating retaining walls around the office building to strengthen the office building's foundation against sinking. This is repairs. It means that they have done some form of repairs works to the office building. So what you do is, this amount supposed not to be, or it is not all that this amount that will be what? That will be allowed. It is not all this amount that will be allowed. So what you do is, this amount must be subjected to the 5% of the written down value of the pool to which the asset belong rule. So you subject that the 140,000 to the repairs and improvement rule. So what you do is, this is office building class 4. So you find the written down value of the pool 4 assets at the end of the year. Find 5% of that, compare that amount to the amount of the repairs and improvement. That should be what? That should be allowed. Then the excess, you know what to do to the excess. You capitalize the excess and you give them capital allowance. The company took a loan, 1 million. Half of the loan was applied towards recurrent expenditure and supporting the company's working capital. The other half was used to construct a warehouse. Now, the loan they took, 1 million, they used 500,000 Ghana cedis towards their working capital. So that is it. So the 500,000, the interest they paid. Where is that one? Interest paid. They paid interest of 150,000. Now, this interest paid was in respect of the loan that they took, the 1 million loan that they took. Now, all the loan was not used on recurrent expenditures. Half of the loan was used on a capital expenditure. The other half was used to construct a warehouse. So it means that the interest portion, the 150,000, we cannot deduct all of them. So you have to disallow half. So 75,000 will be disallowed, which will be capitalized in addition to the 500,000 that was used to construct the warehouse. The interest paid, if you take a loan and you use the loan to construct a capital asset, the interest that you pay on the loan will be capitalized. The interest will be, you cannot deduct the interest. So we capitalize the interest and give you capital allowance on the interest. So it means that we will disallow the 150,000, the 75,000 out of the 150,000. we disallow it, then that 75,000, we will come and add it. We will add it to the 500,000. That will give us 575,000. That amount will be capitalized. This will be done in 2023. So in 2023, you have the pool 4, you have warehouse separately. You have warehouse separately. So you capitalize 575 and give the capital allowance. Then you disallow the 75,000 because the interest, they deducted all the 150. So you have to add the 75,000 back. You have to add the 75,000 back. Now, the other expenses, that's note 5. They say other expenses include the following. So the other expenses were made up of the following. So entertainment allowance. So entertainment allowance will be disallowed.
Disallowed.
The provision for staff redundancy costs to take place in 2025 we disallow. We are making provision for something that will happen in the following year. We cannot deduct it, we disallow it. Third-party vehicle insurance will be allowed. Company lawyer retainer fees will be allowed. Penalty for late filing of returns will be
Disallowed.
disallowed. Audit fee will be allowed. Bank charges will be allowed. Now, additional information. So in the 2022 year, the company make a net loss of 780,000 Ghana cedis. So this is unrelieved loss. So you know the treatment of unrelieved loss. So this will be carried forward for the next 5 years. They've made this loss in 2022. So they can carry it for the next 5 years. So we're in 2023. So if they make a profit in 2023, this loss will be deducted. So we deduct this one before we get their chargeable income. On March 1, 2023, after the examination of the tax returns, GRE confirmed that the tax loss was 560,000 Ghana cedis. They say that the loss they make is 780,000 Ghana cedis. But upon examination of account by GRE, the actual loss should be 560. So we will not deduct the 780. It's the 560 that will be deducted. It's the 560 that we deduct before we get their chargeable income. The next additional information, the company's fixed assets acquired and constructed during the year to 31 December 2022 were as follows. So we have factory building, which will be class 4, computers, which will be class 1, plant and machinery will be class 2, office building will be class 4, furnitures and fitting will be class 3. Motor vehicles, the motor vehicle we were told is a 3-number
Class 2.
motor vehicle. So the motor vehicle, are you going to limit the cost?
3 in number, no. When is 1, we limit.
When is 1?
Motor vehicles, we
Yes.
don't limit.
They are telling us that it's 3.
With all
So
So we should leave it. We should consider it as a commercial vehicle since they are a manufacturing company.
so you should consider them as a commercial vehicle.
Yeah. Yes.
And yeah, but you see, they said 3-number. The motor vehicles are 3. You see, I gave this explanation the last time.
Yeah, you said if they are 3, if there's a motor vehicle
Yes.
without showing the number, we limit. But if there's a motor vehicles,
Yes.
we don't limit.
Yes. But unless they tell you that the 3-number, the question states categorically that they are commercial vehicles or they are non-commercial vehicles. So for example, if like the question says that they are saloon cars, then this one you can limit it. But the 3-number, the motor vehicles, they are 3. You were not told whether if they are saloon car or not, so you don't limit. I gave this explanation the last time. So this one, I don't limit it because you don't know which type of vehicles that they are. But they are 3-number motor vehicles, so don't limit it. Unless the question states that the vehicles are saloon cars and they tell you that they are 3. That one you can do the 75,000 multiplied by 3. But this one, the question didn't say that they are non-commercial vehicles. So you don't limit it. Sina Solomon, you don't limit it. I gave this explanation the last time. If the question say the first one, let's say they just say motor vehicle one, and without them telling you the type of motor vehicle it is,
You limit.
this one you limit. You know that is one motor vehicle, you limit. But if there's like this one, motor vehicles, and they're telling you three number, unless the question tell you that those three vehicles, all of them are what? Are non-commercial vehicles. Then before you can limit. This one, they didn't say anything, so you don't limit anything. So you just use the value like that. You use the 650. Then you do your additions, then you get your capital allowance. All right, so try that. I've explained the treatment of the items in the question, and I believe we can solve the question ourselves. Like as I said, for principles of taxation, they will not load the question like this for you. No, this is advanced taxation question, so they won't load the question like this. And for principles, they like to pick those subtopics under business income tax. They can just pick capital allowance, set question on capital allowance alone. They can just take financial cost, financial gain, leave a set question on it. They can just take repairs and improvements, set question on it. Or they'll give you examination of account like this, but they will not put plenty items in it like this. This is for advanced taxation candidates. But I've explained the items, so I believe we can solve the question on our own. Or I should still write, I should still solve it.
Let's move on. Let's move on.
Okay, I believe that's the decision for everybody in the class. So, all right.
The workload will be easy.
Yeah. So let's do capital gain tax and gift tax. So under the capital gain tax, we know is this for your 10 marks. I believe is it 10 or 15 marks? It's 10 marks.
It's 10.
Yes. So for your 10 marks, this is an area that you can just close your eyes and get your 10 marks. But there are some small theories that you have to do reading on the capital gain tax. So you know, for the capital gain, realization of assets and liabilities. So when an owner of assets parts with ownership of the asset, so it could be through sale, through an exchange, through barter trade, maybe even as a gift, or maybe the person is having a liability, you are owing the liability and your debt is forgiven. We say that you have realized the asset or you have realized the liability. So if you make a gain on the realization, you have to pay tax on it. Now the tax rate is 25%. Previously, it was 15%, which is now increased to 25%. Now, when you make a gain in relating to business, in relating to investment, or the gain is in relating to employment, the principle is that you can add. It's two ways. You can add, but now the two ways was normally for under the old version of the Act 896. But the new one, if the gain is relating to employment, you add it to employment income and tax. Relating to business, you add it to your business income. Relating to investment, you add it to your investment income and tax. Likewise, if you receive a gift, taxable gift, which is in relating to employment, business, or investment, you add them to your employment, investment, or business income and tax. But if you receive a gift or you make a gain, which is not in relation of the three sources of the tax base, then you pay tax at the rate of 25% on it. You pay tax at the rate of 25%. Now, you have to know what is realization of assets, what constitutes realization of assets. And in determining whether you are making a gain or you are making a loss on the realization, you compare your cost and your consideration. Now, the consideration could be the amount receivable from the sale of, or amount receivable during the transaction, or the amount received. So your cost and your consideration, you compare the two. So if the consideration is higher than the cost, you are making a gain. And if the gain is if the cost is higher than the consideration, you are making a loss. And you are allowed, if the realization, the asset is your business asset, you're allowed to deduct that loss from your income before you pay tax. Now you have to know what constitutes the cost. What are the things that will be included in the cost? You know the consideration. The consideration could be an amount you receive. It could be now, it could be deferred consideration, or amount that you may receive in the future, or amount you have received now, consideration. But the cost, you have to know the items, what constitute the cost. What constitute the cost. What you know in accounting is the same thing. All right. So the simple question they can give you is they'll give you direct cost and they'll give you direct consideration. Then you have to compute the cost, compute the consideration, then find the difference and know that if you're making a gain or loss. That one is a straightforward question. Now, we have a lot of circumstances whereby the realization will not be subject to tax. So those ones, you have to take your time, go through the note and read on them. Now, realization of shares and securities. Realization of shares and securities. Now, when the person sold an interest in an entity through a form of shares and securities, or you make a gain on it, you are supposed to pay tax at the rate of 25%. Now, and how to determine whether you are making a gain or you are making a loss on the realization of shares. There are some certain rules you have to follow. So the first rule is that if the shares that the person have sold is relating to the same company, you put all those shares together. The person can have shares in company A, company B, company C. So if the person is selling the shares in company A, the number of shares, all the shares the person have in company A, you put all of them together before you take the one the person sold out. If it is B, all the shares the person have in B, put all of them together before you take the one the person sold out. C to the same thing. You cannot mix them up. You cannot mix shares sold in company B with the one with company A. You cannot do that, no. So shares relating to the same company is put together before the one taken out, before the one sold is being taken out. Now, how will you determine the cost? The cost that you'll be comparing with the consideration. The consideration is normally forward. So they'll tell you the person sold these shares at the market price of this, or the person sold this number of shares for this amount. That's the consideration. Even if they don't give you the consideration straightforward, when they tell you the number of shares the person has sold and the amount per share, which will be the market price at the time of the sale of the share, you just multiply and get your consideration received. All right. Now, how will you get the cost? So in getting the cost, there's a formula we use. What's the formula for getting the cost? I think it's A all over A plus B, all this multiplied by C. Is it the formula?
Yes.
All right. So you know the E. What's the E? What's the E?
Is the proceeds from the disposal.
All right. Is the proceed or the consideration received. The B is what? The B is what?
Unsold share.
The
Unsold
value.
share.
So the market value of the remaining shares of the unsold shares. So the number of shares remaining multiplied by the market value at the time of the sale of the shares. That will give you the market value of the shares remaining. Then the C is what?
The
That's,
cost before disposal.
all right. So the value of the shares before disposal, the cost of the shares before the disposal. So we do this. So when you get the cost of the shares, that will be compared with the consideration. When a person incurred any agent fee, any commission fee, you add the commission, the commission of the agent, you add it to the cost before you compare that value to the consideration to know that if you're making a gain or you're making a loss. Now, let me talk briefly about realization with replacement. Realization with replacement. You sold an asset, then the consideration you have received, you use part of it to acquire another asset. The principle is clear. The principle is that maybe if you have based on every information available to you, you believe that the assets you have now. You'll be selling that asset in the future. So the law is that 6 months before the sale of the asset, you acquire similar assets. You acquire similar assets. Or after 1 year after the disposal of the asset, you acquire similar assets. The cost that you have used on these assets, we will compare this cost with the total of the old cost that you have and see whether if there is any additional relief we give you before you calculate your gain. So we will do that. So there's a question that we will solve on that. How realization with replacement, how is the calculation done to determine the gain on realization or the loss on the realization? All right, so let's take the first question. So Equia is a shareholder of Anam. This is your more question, and I believe you guys have solved it. She's a shareholder of Anam Company Limited, a company not listed on the Ghana Stock Exchange market. Now, Equia has the following transaction in Anam Company Limited. So on July 1, 2008, she purchased 200 shares for 184,000 Ghana cedis. She purchased additional shares of 120,000 on October 1, 2008 at a price of 1 Ghana cedis per share. Again, she purchased 95,000 shares on June 16, 2009, the price of 1.15 Ghana cedis per share. On July 20th, 2009, she received bonus shares for one for every 10 shares currently that she had. So you know the treatment of the bonus issues. Bonus issues will not increase the value of the shares because bonus issues does not come with any value. It will only increase the stock of shares, but it will not increase what? The value of the shares. And bonus issue will be based on the number of shares that you have before the bonus issues is being made. Then right issue too is the same thing, but right issue will come with a value. The right issue will increase the stock of shares and the value of the shares. So she received one for every 5 shares that she had as at 31 December 2015 at a price of 90 pesos per share. Right. On 15th November 2017, she sold 340,000 shares for 408,000 Ghana cedis, paying commission of 2.5% on sale value to the brokerage firm that facilitated the sale. The proceeds received from the sale was 0.10 pesos or 0.10 Ghana cedis per share, lower than a similar share on the Ghana Stock Exchange market. So it means that this transaction, the sale of the shares, the selling price per share was not at the arm's length price. Now, how will you know the amount that she received? She sold 340 shares and for 408,000 Ghana cedis. So it will be 408 divided by 340. How much would that give you per share? That'll give you 1.2. So she received 1.2, which is 0.10 Ghana cedis lower than the amount that she received. So actually, in actual sense, you're supposed to receive, this will be plus 0.1. So this will give you 1.3. So the share is supposed to be, the market price at the time of the sale is 1.3 Ghana cedis. But she sold it for 1.2. So we have to calculate the arm's length price. So it means that for us to get the consideration, we are not going to use the 408. We are going to calculate the consideration using the 1.3. So that will give you 340,000 multiplying 1.3. So that will give you 442. So the consideration in actual sense supposed to be 442,000 Ghana cedis, not 408. So this is the 442 that we are going to use to do our calculation. So the requirement is you have to compute the capital gain tax, if any. So let's do that.
Senior,
Yes.
Please kindly go over that portion for me.
All right, so the question is that
Mm.
she sold 340,000 shares for
Okay.
408,000 Ghana cedis.
Okay.
Now, she paid commission 2.5. Let me leave that one. Now, they are telling you that the proceeds received from the sale was 0.10 Ghana cedis per share, lower than a similar share on the Ghana Stock Exchange. The reason is that, see, the company, Anam Company Limited, is not a listed company. They say the company is not a listed company. So it means that their shares are not traded on the Ghana Stock Exchange. So
Yeah.
that's the main reason why, as at the time of the sale, they will not have the actual market price per share because their shares are not traded on the Ghana Stock
Let's
Exchange.
go.
Yes.
Yeah.
So the 408,000 that she has received is lower. It's lower 0.1 Ghana cedis per share. So what you can do is you can just do 340 multiply by 0.1. Whatever you get, add it to the 408. You will still get the 442,000 Ghana cedis. You will still get. So, but we need the market price per share. After the time of the sale of the shares, we need the market price because that's what we are going to use to value the remaining shares to get our B. So the market price is that. So you have to find the 408 that she has received from the sale of 340,000. How much did she sell the shares? You have to get that. So that will be 408 divided by 340. That will give you 1.2. It means she sold the shares for 1.2. But in the actual sense, the shares are trading 1.3. The 1.2 is 0.1 Ghana cedis per share lower. So in
Okay.
actual sense, the shares are trading 1.3, not 1.2. So it
Okay.
means that the market price at the time of the sale of the shares is 1.3, not 1.2. So we have to use the 1.3 to determine the proceed that's supposed to be received. Everything must be based on the arm's length price. I believe you are fine.
Yes, sir.
All right. So let's solve the question. Capital. I believe this will be question 18. The name is Equia. The name is Equia. So we have to compute the capital gain tax, if any. So computation of capital gain tax for 2017 year of assessment. All right. You know how you put up your structure. You know how you put up your structure. So you have your dates, then you have the details here. After the details, you have the number of shares. Number of shares. Then you have the price per share. Price per share. Then you have the value of shares. Now, the first date is on July 1st, July 2008. She purchased shares. So purchase of shares. The number is, what's the number? 200,000. We were not given the price at 184,000 Ghana cedis. So how much will be the price per share? How much will be the price per share? So that'll be 184,000 divided by 200,000. That'll give you 0.92. The second date on October 1, 2008, she purchased shares. She purchased 120,000 shares for 1 Ghana cedis. So the value will still be 120,000. The next date on 16th June 2009, she purchased shares again. This time around, she purchased 95,000 shares at 1 cedi 15 pesos. So 95,000 multiplied by 1.15. So this will give you
109.
109,250. All right. This is the shares that she have purchased before the bonus issue was done. And I said that bonus issues will be made on the existing shares of the what? Of the shareholders. So let's find the existing shares. So the total existing shares will be, this will be 120, this will be 320 plus 95. This will give you 415,000 shares. The value will give you how much? 184,000, 120,000, 109,250. To give you 413,250. All right. The bonus issues was done on what date? Is that 20th July 2009? Bonus issue was done. The bonus issue. Now the bonus issue, what's the basis for the bonus issue? It's 1 for 10, right? So bring 10 of your existing shares and come for 1 new bonus shares. So that'll be 1 for 10. So that'll be 1/10 multiplying the existing shares. So 1/10 multiplied by 415,000. That will give you what? I'm getting 41,500. The bonus issues what? It will not come with value. It will only increase the stock of shares. Now, the next thing that followed was the right issue. So you have to find the value of the existing shares before the right issue. So 415,000 multiplied by 41,500. You get, this will give you 456,500, and the will still be 413,250. All right. Now, on what date? On what date was the right issue done? What date was the right issue done?
1st January 2017.
Okay, 1st January 2017. All right. So you put the date there. So on 1st January 2017, there was a right issue. I think 1 for 5.
Yes, 1 for 5.
Okay, so that'll be 1/5 multiplied by 456,500. That will give you 91,300. So the right issue at what value? 0.9. Is that not it?
Yeah.
So 0.9 multiplied by 91,300. You will get 82,170. All right. So this is the number of shares that she had before she sold the shares. So the number of shares you have before selling the shares, this will give you 456,500 plus 91,300. This will give you 547,800. And this will give you a 495,420. All right. Let's move on. So let me put my date here, the details. number of shares, price, my price here, price per share, then the value of the shares. Now, on the sale was done on 15th November 2017. So on 15th November 2017, she sold shares. So sale of shares. Now she sold how many? 340. So take the 340 out of, who is that? Who is that? Who is that? Who is that? So take the 340 out of the 547,800. The remaining shares will be what?
117,800.
It will be more than that.
207,800.
Is it not 457?
That's 547.
Oh, sorry.
All right. So this is the remaining shares. This is the remaining shares. All right. Now let's find the cost of shares. The cost that will be compared with the consideration. So the cost of shares, which is equal to A all over A plus B multiplying C. So our A is equal to what? Is the market value of the share sold. So it's the proceed from sale of shares. So this will be equal to what? So you can just do it. We were told that the shares sold was not at the what? The actual market price of the shares. It was not at the actual market price of the shares. So this will be, she sold 340 multiplying 1.3. So this will give you 442,000. Our B is the market value of the remaining shares. So market value of remaining.
Is it 1.30 or 1.80?
1.30. It's 1.3. Market value of the remaining shares. So this will be the 1.30 multiplying by 207,800. What are we getting?
270,140.
270,140. The C is the value, is the cost of the shares before disposal. Cost of shares before disposal, which is equal to 495,420. So our cost of shares will be equal to the A, which is 442,000 divided by the 442,000 plus 270,140 multiplying 495,420. So the cost will give you what? How much is the cost? How much is the cost? I'm getting 256, 489.60. All right. Now let's calculate our gain. Now computation of the gain.
Please, can you go back to the calculation, the cost?
Okay.
So I got 307,000, 307,489.60.
And then let me do it again.
Yes, please.
Let me do it again. Mr. Philip, have you done a calculation?
I'm almost done. Yeah, I have 307,489.59.
Okay, then maybe I did a mistake.
Is it the same as what my colleague has gotten?
Okay, so it be 307
489.59.
489.6. Okay, all right.
0.6, right?
Yeah, 0.6 will be okay.
Yes, to the nearest whole number, to the 1.6, yes. So that would be 307. Okay. Let's compute the capital gain. So we have our consideration receipt, which is 442,000. Then we take off our cost of the shares, which is 307,489.6. There was a commission. So we add the commission. The commission is 2.5% of the 442,000. How much would that give you? You're getting 11,050. So in addition to 307,489.6, this will give you 318,539.6.
Commission, is it 2.5
I believe so.
or 25?
No, it's 2.5.
2.5.
25 there also. So the gain,
He's sharing in 4 quarters.
the gain is 123,460.4. So this is the capital gain. Then you tax this at the rate of 25%. So 0.25 multiply 123,460.4. So the tax is 30,865.1. So you are done with the question. And now move on to the next question. Can I leave the page or I should go slow?
You can leave.
All right. The B part, an individual who is required to furnish the Commissioner General with a return in relation to a gift has to do so to enable the Commissioner General subject it to appropriate tasks. So you are to explain the treatment of a gift not received under employment or business. So what's the treatment? What will be the treatment?
Who is required to furnish Commissioner General with a return in relation to gifts has to do so to enable the Commission subject it to appropriate tax. We are required to do or explain the treatment. A gift not received under employment or business.
Yes. How will the person treat it? Hey, this one should you think before you answer. So the person will just pay tax at the rate of 25%. Huh?
A gift not received under employment or business.
Yes. Oh, I've already explained this. When you receive a gift in relation to employment, business, or investment, you add it to employment, investment, or business income and pay tax. But if you receive a gift which is not in relation to employment, business, or investment, the individual will declare the gift, pay tax at the rate of 25%. That's all.
How will you share my gift with me into 4?
Okay. We want tax for developmental purpose. We want the revenue for developmental purpose.
Oh, it's too much.
Okay, let's take question 19. Question 19 is on, I did not bring any question here, the direct one. The one that will give you the cost, just add all the costs and compare consideration. Those ones are direct. So the question 19 is on realization with replacement. Kwabena Fortson, a car dealer, bought a plot of land costing 2,800 Ghana cedis in February. He put up a garage on the costing 40,000 and insured it at a cost of 4,000. So you know the cost already. So he bought a land 2,800. He put up a garage 4,000, 40,000, and he insured it 4,000. So those were all the costs he has incurred. After running his business for a while at this location, he realized that the place is a flood-prone area. He therefore sold his garage for 75,000 Ghana cedis, incurring an agent fee of 2%. So on the selling price in August 2020. Now, this is August 2020. The law is that I've already explained the law. So if you acquire similar assets within the next 1 year or 6 months before the disposal of that asset, the cost that you have incurred, there will be what we call a rollover relief. Now, on March 2021, he bought another garage costing 60,000. Calculate the capital gain, if any, by Kwabena Fortson to be included in his chargeable income and comment on your computation, 5 marks. So let's do this calculation. So this is question 19. Kwabena Fortson. Computation of capital gain tax for, I think it's 2021 year of assessment. So the consideration the man received, the consideration is 75,000. Consideration is 75,000. Then let's take off the cost. So we deduct the cost base. So let's take off the cost base. So the cost base is made up of what? The initial cost of the garage. How much is the initial cost? 40,000. He insured the garage, insurance. Insurance was 4,000. The land he bought before putting up the garage on 2,800. The agent fee that we have incurred. What's the percentage of the agent fee?
2%.
2% of 75,000. This will give you how much?
1,005.
The land is
1,005.
it 28,000 or 2,800?
2,800. So the total cost will be 48,300. So what is the gain here? What is the gain here? 25,000 minus 48,300. 26,700. Now, this is not the gain that he will pay tax at the rate of what? 25% on. No. He used 60,000 out of the proceed to acquire similar assets on March 2021. So let's give him the relief, the rollover. We deduct the rollover relief. The rollover relief will be calculated at the replacement cost, which is 60,000. Now, this is the 60,000 he used to what? To buy another asset. But he used what? 48,300 on the original asset that he sold. So we take the cost base out. The cost base of the asset to be taken out, 48,300. The excess amount will be given as a rollover relief. So this will give you 11,700. So when you do that, you will not get the capital gain, which will be taxed at what? 25%. So this will give you how much? So this will give you 15,000, yes. So 25% of 15,000 will give you 25% of 15,000 will give you 3,000.
750. 725 also.
750. So this is the tax that you pay. So this is how you calculate the rollover relief. The replacement cost, the amount the person used to replace the asset. Then you take off the cost base of the asset, because the cost base is already deducted from the proceed before you get this gain here. So when you take the cost base of the additional cost he has incurred, which is 11 what? 800 will be taken out from this amount before the remaining amount is the gain that he will be paying tax on. Can I move on? Let me solve a similar question like this, then we'll close the docket on the capital gain tax. Then we move to withholding tax. The B part of the question. Amuzu put up a building at a cost of 26,250 Ghana cedis 7 years ago. He sold the building to Amwaku for 32,000 Ghana cedis. He, within 1 year after the sale of the building, acquired a new one for 32,000 Ghana cedis. Determine the capital gain, if any, on the above transaction as it would be recorded in the books of Amosu. Will there be any capital gain here? Will there be a capital gain here? Just you looking at this question, will there be any will there be any gain that will be subject to tax?
Mm.
Will there be any gain? Just looking at the question without solving it.
Say no gain.
Yeah, there will be no gain. There will be no gain.
The one we just saw.
No, the B part, the one I've just read, the Amozu, the Amozu man. There will be no gain here. Because if you look at it, the total cost of the building is 26,250. He sold it for 32,000. So there will be some small gain over here. So that will be the consideration. Okay, let me just put up the structure fast. This is question 19B. Amuzu. Computation of capital gain tax. The consideration is 32,000. The cost, we take off the cost. The cost is 26,250. When you take it as how much you get? 5,750. We deduct the rule over relief. The replacement cost is 32,000. So when you take off the cost base, which is 26,250, this will still give you 5,750. When you take the relief out, the gain will be 0. So there will be no capital gain. The capital gain will be 0.
Stop.
I believe we can move on. So try your hands on the rest of the questions. I think, let me see the next one. Kwamivi constructed a building at a cost of 15,000 on April 1, 2016 at Wager. In 2020, due to the flooding caused by rainwater, he had to undertake repairs to the building. So there's a repair here. He has insurance of 500 that he has paid all the premiums up to date. He decided to relocate from Kaswa to Ajingano, and that sold the building at a cost of 19,500, paying agent of 1%. Calculate the gain, if any, on the disposal of the building. So let's solve. I think this is the last question I'll solve. Then you go and solve the rest. Then I move to withholding tax. So this is question, I think question 20. The name of the taxpayer is Efu Kwamivi. So computation of capital gain tax payable. So I think this is the first.
Kwamivi.
The consideration my brother received from the sale of the building. How much is the consideration? He sold the building for 19,500. All right, then we deduct the cost. So the cost base, how much did he use to put up the building? The initial cost, how much is the initial cost?
15,000.
15,000. He has done repairs. Repairs to the building is how much?
1,000 cedis.
The insurance is how much? 500, right?
500, yeah.
The agent that he have contracted, the agent will take 1% of 19,500. How much would that give you?
That's 195.
Let me mute this person and come. All right. So the agent fee, 1% of 19,500, that will give you how much?
195.
195. So the total cost will be how much? 16,695. So when you take it out of the consideration, the gain, you are doing the first requirement. So the capital gain will be 2,805. So you pay tax here at 25%. So how much will be the tax?
701.25.
701.25. So this is the tax payable. Now let's do the second requirement. So the second requirement, what happened in the second requirement? So in the second requirement,
The tax is on 2805.
yeah, I believe so. Yes. He used 18,000 out of the proceeds received from the sale of the building to acquire a similar asset, to acquire a building at where on September 1, 2020. All right. At Ajingano. So 18,000 was used to acquire a similar asset. So let's see whether there will be any rollover relief that will be given out before we charge him the tax. So
Listen,
yes,
flip to the last lesson. Let me see the last lesson here. Okay, I've gotten the same.
okay, all right. So the B part, we have to compute the capital gain tax. So computation of capital gain tax payable. So we start with the capital gain, which is 2,805. We deduct the rollover relief. So the replacement cost is 18,000. Then we take off the cost base, which is 16,695. When you take it out, the additional relief is 1,305. So the actual capital gain here will be 1,500. So is the capital gain, and the tax will be at 25%. It will give you 375. So go try the rest of the questions on the capital gain. Let's move on to withholding tax.
So,
Please, just a minute. Just a minute.
so when the replacement takes place, let's say after a year,
Yeah.
how will you treat it at the replacement cost side? The
Yeah,
rollover.
no, after the year, we don't give a relief. If
So,
the replacement takes place after 1 year, we don't give you any rollover relief. No, it means that the first gain we get here, you are going to pay tax on that gain. That's all.
okay, that's fine. Thank
Yes.
you.
So the replacement must be within 1 year. If it is after 1 year, then it means that the first gain that you get from the computation, this is the gain that you pay tax on. Can we move on to withholding tax? Withholding tax is
Yes.
very simple. We know the rate. No examiner will give you the rate of the withholding tax, and I've put up a summary of the withholding tax. The withholding tax rates that you are supposed to know. There are some other questions too I have in the document. Try and provide answers to them. So the withholding tax, we know it's a form of advance payment of tax to GRA. GRA, we need the money in advance. We need the money to develop the country. So we cannot wait for you at the end of the year before you come and pay. So when you transact some form of business that is withholding tax deductible, then withholding agents have to deduct that tax and pay. And you have to know the date for filing the withholding tax or the date for paying the tax withheld. So the law says that by the 15th day of the following month that you have withheld the tax on the withholdee, you have to pay that tax on behalf of the withholdee. But if you are not an withholding agent, you cannot withhold any tax from a payment that you have made towards a customer. You cannot do that. So there are different types of withholding rates. So you have to know the rate. So
And then, please,
yes,
what makes somebody a withholding agent?
what makes somebody a withholding agent?
Mm.
Yes, there is no a requirement. There is no threshold that you be. So it depends on GRA. They will register you. They will give you that status as an withholding agent.
But you just said if you are not a withholding agent, you can't withhold tax.
Yes. So that's what I'm saying. That if GRA have not given you that mandate, that means you are not an agent, so you cannot withhold the tax. There are
So
certain
the requirement will be when GRA get to give you that accreditation.
it's the same thing I'm saying. That if GRA give you that accreditation, then you can withhold. But if you don't have that accreditation from GRA, then you cannot withhold. I believe we can move on, senior.
Yeah.
Yes.
Boss, I wanted to let's say contribute or maybe ask, but I learned that under the law there are certain companies that are already allowed to withhold tax on behalf of some customers in their dealings. So, what about those ones too?
Yes. So it's what we are saying also is the same thing. So those
It's part of the accreditation.
It's part of the accreditation, yes.
When you register as a company, you automatically qualify.
Exactly, yes.
Okay, okay.
It's part of the accreditation. When you register as a company, GRA will give you the withholding agent status. So it's part of the accreditation. One thing is an individual. Individual you cannot withhold. How can GRA trust you that you withhold the tax and come and pay? But if you are a withholding agent and you are violating the tax principles, that accreditation will be withdrawn from you. You are an agent. You are not keeping proper books of account. You are not filing the returns on the due date. You withhold the tax, you will not come and pay on the due date. That accreditation status will be taken out from you. So if
Is it just taken or they will surcharge you?
Yes. That's the reason why there are penalties for not filing the returns at the due date, for not paying the tax at the due date. Yes. So
So I was also thinking you would apply to the Commissioner General for that.
yes, if it is not given to you, if it is not part of the accreditation from the date of registration as a company, then you apply. Now, when you apply, there are certain conditions GRA will check. They will come and inspect your book. You will always comply with the tax principles. You file all your returns on a due date. You keep proper books of account. You see, everything is about record keeping. So you can prove to the Commissioner General that, okay, you maintain proper books, so you keep proper documentation. Then GRA can trust you and give you the withholding agent status. But if you register as a company, straightforward, it's part of the accreditation, the withholding agent status will be given to you. But if it is not given to you, then you can apply. When you apply, GRA will check your records. Are you filing all your tax returns on due date? Are you paying your all taxes on due date? If you are doing that, if you have proper track records, then GRA can trust you. The Commissioner General can trust you and say, okay, if you take our money, you will not chop our money. You come and pay the money. You pay our money. Now, so the withholding taxes, you have to know the rate. No examiner will give you the rate. And you have to know withholding tax on account and withholding tax that are final. So I've given you the summary of all the withholding tax rates and whether the tax is final or the tax is on account. So dividends, we know dividend is 8%, which is a final tax. And when the tax is final, it means the tax withheld satisfies the final tax liability of the taxpayer. The income that suffered that tax will not suffer any expenditure deduction again. On account, it means that it is not final. It means that income may suffer any other expenditure deduction again. There may be other tax that will be taken out from that income. So that's the main reason why that income, the gross amount, added to your income. Then the tax that has been withheld after you determine your total tax liability for the period, the tax withheld and paid on your behalf, and you have the withholding tax credit certificate, then you can deduct that tax from your total tax liabilities before you pay your net tax liabilities to GRA. So you have to know the distinction on account and final. Lottery winnings, now we know lottery winnings, we are also offering a 10%. Consideration received on realization of assets, 3%.
Who is offering it?
Hello, sir.
Yes,
The lottery winnings.
yes.
I thought there was a threshold, or
That threshold is no more there. Now, if you win,
okay.
straightforward. If you win, that 3,000 something is no more there. When you win, straightforward, come and pay. You will not even, you take it out. Are you not suffering it? Senator Solomon, are you not paying the 10%?
On
Okay,
lottery.
me try to check.
Is gamblers who are suffering?
Oh boy, they take the thing small. Even if it is 100 CDs.
Andre, I will tell you.
Even if it
Is
is
gamblers?
even
I
if
know
it
the
is
chop. I know the chop.
I know the chop. It is take, but I know the chop.
Gamblers are suffering.
But the thing be wickedness, oh Charlie. You go stay you no go chop. You go stay you no go chop. The day where God won't bless you small, you chop something small now, Charlie, they go take the 10% out. But
I think government is looking for cheap money to chop.
so if you lose there, that one you don't consider them, Charlie.
Then we charge them.
Charlie,
A country called Ghana.
it be bad. It be very, very bad. So the rates are here. All the rates, you have to know them.
A country called Ghana.
And non-final. All right. Branch withholding
8%.
on branch profit.
After the 25%.
Is it my network or is it from Senior Solomon?
Branch profit.
8%.
What's the rate of which? Yes. What's the rate of withholding?
8%.
Is it 8%?
8%.
All right. Thank you very much. Final or non-final?
Final.
All right. Because
Final.
branch profit will always relate to a non-resident person. So all tax relating to non-resident person is a final tax. So the branch profit tax, if you are a non-resident person, you have a company in Ghana. That company will be classified as what we call permanent establishment, PE. PE is in advanced taxation. When you come under advanced taxation, we talk about it more. So the profit after tax of your company. So those that are foreigners, that they have company in Ghana, that the owners themselves are not here. They are there, somebody is managing the company for them over here. The company will be treated as a resident company because the company is incorporated in Ghana. The management and everything is done in Ghana. So the company will be treated as a resident company. They will pay tax, withhold tax, and do the rest.
5%.
Now, the profit that will be repatriated to the owner. When that money is being sent to the owner, that money will be what? We take our withholding tax, 8% on it. The taxation there, Charlie, we need money, Papa. The company itself will be taxed, too. The company will be taxed.
Double tax, but
The company will be taxed. The company will be taxed as a resident company. Look, they will enjoy all the incentives, locational incentive, and the rest. Now, the profit after tax for them, no, that they'll be sending to the owners. When they are sending that money to them, because that money is leaving country, we will still take tax on it again, 8%. So I think that the first question here is relating to that. And there are certain theories under withholding tax, conditions that a person may satisfy.
Broad day robberies.
Conditions that a person may satisfy if the person is applying for exemptions of withholding tax. You have to know all the conditions. I think that's the question that came in your pilot question. Conditions that the taxpayers will satisfy if they want an exemption from payment of withholding tax. So that they can use the money and do the business, and the end of the year, then they'll go and pay. It doesn't mean that they will not pay. If they give you exemption, it does not mean that you will not pay the tax. Just that at that moment, we will not deduct the tax. But at the end of the year, when you are filing your returns, you will come and pay. Yeah, it doesn't mean that they are exempting you, so you will not pay. You know, the withholding tax is like advanced payment of tax. So at that moment, that's the reason why there are some conditions over there. The last condition is when the taxpayer is suffering what cash flow challenges. The company is having liquidity problem. If that tax is taken now, it will affect them. So we allow you to apply for exemption, use the money. At the end of the year, come and file the return and pay. So those conditions, you must know them. So let's take the first question. And I gave you guys some brief summary of withholding tax on interest and dividend. I believe you guys have gone through it. Withholding tax on interest and dividend. I believe you guys have gone through that document. It is very, very helpful. Let's take the first question. Gidi Major, Ghana branch declared a loss of 500,000 Ghana cedis in 2021. They submitted their returns for 2022 year of assessment in March 2023, and below is the extract of their returns. So 2022, they make a profit now, which is 3 million. They make a profit of 3 million. Additional information. Depreciation was deducted, capital allowance was granted, and the capital allowance has not yet been considered. Can you defer capital allowance?
No.
Can you defer capital allowance?
No.
All right. So capital allowance, once granted, is not deferrable. So you cannot postpone the amount of capital allowance to the following year. That okay, this year you're giving me capital allowance for 2022. I will not take it now. Let me go and take it in 2023. It is not allowed. But this question, the capital allowance is for 2022, and they have not deducted it yet. It doesn't mean that they are postponing the deduction. Yes, that based on the returns they have submitted, they have not deducted the capital allowance yet. So we still have to deduct it. You have to determine the branch profit tax that the company will pay for 2022 year of assessment. So this question is very simple. It's very, very simple question. Withholding tax questions are simple. If you know the rates, they are very, very simple. And you have to know withholding tax on goods and services. Withholding tax on goods and services. And you have to know the threshold for deducting of withholding tax for goods and services. The threshold is 2,000. It's not 2,000.
Yes, sir.
Yeah,
2000.
All right. Okay. So this is question 23. You guys should be giving me the figures fast so that maybe by 8 we end the class so that you go and do your studies.
we can learn up to 3.
Yes. So the Major Ghana branch. All right. So computation of branch profit tax. How much is their net profit? 3 million.
3 million.
All right. So let's do the add back. What are we adding back?
Depreciation.
How much is the depreciation?
15,550.
Not the only thing we are adding back. I believe so.
Yes, sir. Yes, sir. That's all.
Yes. 15,550. So how much are we getting?
3015. 000.
All right. So let's deduct our capital allowance. How much is the capital allowance?
It was 14,850.
What again are we deducting?
The unredeemed loss.
The unrelieved loss, which is, I think, 500,000, right?
Yeah, 500,000.
Okay. So what is the profit before tax or the chargeable income? Chargeable income will be how much?
2,950,700.
2,950,700.
700.
So calculate the tax for me. Tax at 25%.
No, sorry. The
Yes.
figure again is 2,500,700.
Okay. All right.
2.5 million 700.
So calculate the tax for me.
625,175.
So what's the net profit before that? What's the profit after tax?
1.8 million 75,525.
Okay. So calculate the branch profit tax for me.
150,000 and 42.
150,000
1,042.
and 42. So this is what the question says we should calculate. So you can now do
the
next.
corporate tax is what? 625, 175, right?
Yes. So the branch profit tax, it will be charged on the profit after tax. So you have to calculate your tax, take the tax out before you can compute your branch profit tax. You, Charlie? Okay, then borrow that. All right. So let's move to the next question. Withholding tax, the the 10 marks there, if you don't get a 10 marks for a year, Charlie, it go over you. You need a 10 marks from a year. The retention of tax by one person when making payment to another person regarding goods supplied and services rendered and remitting the same to the GRE is sometimes described as an easy way of tax administration. Explain the obligations of a withholding agent. What are the obligations of a withholding agent? What are the obligations of an withholding agent? So if you make a payment, you are an agent, you are making a payment to someone which is in respect of a transaction which will be subject to an withholding tax. It is your duty to withhold the tax and pay to GRE on or before from the 15th day of the following month. If you don't do that, there are penalties that you pay. What's the penalty? What's the penalty? So you have to let the examiner know that if you fail to withhold the tax and pay the tax on the due day, you will pay penalty. And what's the penalty?
5.
Senior Derek, there's a noise coming from your end.
Yes, sorry. 500 cedis times, I think 10 cedis times each number of days that.
For withholding,
500 cedis plus 10 cedis times each number of days in default.
that's for withholding agent. Is that for withholding agent or is that for payment of tax?
Default of tax.
So is that the same way for withholding agent? I want to know. If you have withhold the tax but you didn't pay on the due date, if you withhold the tax but didn't pay on the due date,
I think you pay interest 125%.
No. That one you don't pay interest. It's the penalty you pay.
Okay, so then it's the same.
So the very first day you pay 10 cedis, or is 500 cedis.
You pay 500 cedis first times the number.
You pay 500 cedis the very first day.
Yeah, plus 10 cedis per each number of days in default.
All right. So what about if you fail to withhold the tax?
That one, if you got penalty.
Oh, you just pay two times the amount of tax that you are supposed to withhold.
Two times the total amount.
Yes, 2 times the amount. So if you are supposed to withhold maybe 50,000, you fail to do that, it will be times 2, so that'll be 100,000.
They are taking you out of business.
And if you can go and chase what? If you can go and chase the person that you have not withhold on, go and chase the person and see if the person will pay you. And that one you have to pay. You will pay from your own pocket before if you can go and chase the person, fine. And the penalty, you cannot go and take the penalty from the withhold deal. You have let's say you have withhold the tax already and you refuse to go and pay on or before the 15th day, and they charge you 500 cedis the very first day, 10 cedis as the default continues. You cannot go back to the person you have withhold on and say you should come and pay the penalty.
No, but this one, when I omit, I can go back and tell him that I've made a mistake.
Oh, yes, you can go back, but you pay the penalty 2 times the amount. You can go back and tell the person you made a mistake and see how the person will delay you.
Now, at least I'll have to, as it were, question myself small.
Okay, that's fine. And so the next time you be careful. 10 qualifying conditions for exemption from withholding tax. So all the 10 conditions. You are keeping proper books of account, you'll be exempted. You demonstrate that you have cash flow challenges, you will be exempted. you pay all your tax on due date, you file all your returns, your check have not been dishonored, all the conditions, you'll be exempted from withholding tax.
When it's not up to
I think
2000.
When you prepare a proper book of accounts, they will exempt you.
or if you keep proper records, always your records are in place. If the GRA know that, you see, I said something earlier that the exemption doesn't mean that you will not pay. Just that period, you will not pay the tax. So use the money around your business. At the end, file the returns and come and pay. So if you have proper books of account, GRA know that, oh, definitely, all the exemption, all the tasks we are exempting you, you will keep the documentations and come and pay at the end of the year. So they can exempt you. Oh, don't pay now, but later at the end of the year, we know.
What's the approach in this? Will you go to them and tell them that these are difficulties or challenge you are facing?
Yeah, you apply to them. You apply first. One application is the first point. You have to apply. You have to apply application
in writing.
Yeah, you apply to them. That year, maybe that year you projected that maybe you're having cash flow challenges. So that year, at the beginning of the year, GRA know that for the previous years, or you have proper you keep proper books of account. You pay all your taxes on due date. You have been filing all your tax returns on the due date. But that year, you apply to them that, oh, you're having cash flow challenges. So you want an exemption from withholding tax payment so that at the end of the year, you come and pay. Fine, they will exempt you. If all the conditions are there, they will exempt you. That year, every transaction, you can do every transaction, the tax will not be withheld. The tax will not be withheld. So that you use the money for your business at the end of the year, then you come and pay. I think I solved this question here, this question in class. So kindly solve it. The following relate to payments made by Manita Limited, a company resident in Ghana, to another resident company. Both companies are not exempt from withholding taxes. So there are goods, services, and works. So we know the withholding tax on goods. Goods is what? What the rate
is? Goods
is 3%.
3%. Services is 7.5.
7.5. And the other is 3.
Okay. And all of them, the value must be 2,000 and above. But yes, above 2,000 doesn't mean that you will not pay tax on the 2,000. No? You pay tax on the whole amount. So let's say if you sell 2,100, you have met the threshold. So you change the tax will be applied on the full 2,100. It doesn't mean that the 2,000 will be taken out before you be paying tax on 100 cedis. No. You pay tax on all the what? It means that it has met the taxable value. All the 2,000 will be taxed. All the amount will be taxed. So upon scrutiny, it came out with the following information that goods above include dividends of 10%. Dividend payment of 10%. So the goods is 3 million. So you have to take the dividend out. So I think 10% of this amount will be what? Will be 300,000. So it means that the 300,000, that is in relation to dividend. So the actual value for goods that will be 2.7, 2,700,000. That will be subject to tax at the rate of 3%. Then the withholding tax, which is the 300,000, will be the dividend, which is the 300,000, will be subject to withholding tax at the rate of what? 8%. 8%. The service above relate to 50% management and technical services and 50% consultancy services. The two companies all of them are the resident companies.
Yes.
All right. So the withholding tax, the residency status also counts. If you are a resident person, the rate is different from if you are a non-resident person. You have to take note of that. The two companies, they are all resident companies. So what about if the company making receiving the payment is not a resident company? What will have been the tax rate on the goods and services? So withholding tax in respect of goods, works, and services. In respect of a non-resident person, what the rate?
20%.
Thank you very much. So the management service. So the services are above. So it means that, where am I even going? The services above. The services is what? 1.2. 50% relate to technical services. Management and technical services. What's the withholding tax rate for management and technical services in respect of a resident person?
7.5. It's service. It's a service.
Thank you, senior. It's a service, so that will be 7.5. Then what about the consultancy?
Same 7.5.
The same 7.5. All right. The works is 2 million. So this will be subject to tax at the rate of
5%.
5%. So you are good to go. B part, Mike Cotex. It's a resident individual received interest from the following. So receive interest from resident financial institution. So that is a bank, 10,000. Pearl Microfinance, that is 9,000. ABC Limited, it's an oil marketing company, that is 8,000. You have been invited to help with a possible withholding tax treatment of the above transactions. Now, for an individual, resident individual, interest received by an individual is exempt from tax. An individual, if you receive an interest, is exempt from tax. So there are some with interest that are exempt from tax. One is interest received by a financial institution. If you're a financial institution, you receive interest. That interest will be exempt from tax. Financial institution, resident financial institutions, their interest is exempt from tax. And there are some other form of exemptions of withholding tax from interest. So you have to take note and get the rest. Then I said that resident individual, if you receive interest, is exempt from tax. So in this question, my quotas is a resident individual, receive interest from resident financial institution. So this will be exempt from tax. Pale Microfinance, 9,000. This will also be exempt from tax. ABC Oil Marketing Company, the 8,000. The 8,000 also be exempt from tax.
Is it interest?
It's subject to 1% withholding tax.
1% withholding tax, yes.
Yes.
An individual, the principle is that if you receive an interest, will be exempt from tax. But if you receive an interest from a company that is into mining or a company that is into petroleum operations, the interest you receive will be subject to withholding tax at the rate of 1%.
1%.
So take note of that.
So royalties is 1%, right?
Royalties is 5%. The withholding tax is 15%. Royalties, the withholding tax is 15%, which is on account. Yes, it's the interest that is the 1%. If you are an individual, you invest in a mining company, you invest in oil marketing company or petroleum company that is engaged in the petroleum industry. You are an individual. Any interest you receive will be subject to withholding tax at the rate of 1%. It will not be exempt from tax. It won't be exempt from tax. All right. The last question. Below are the various contracts awarded to KPP Books and Stationery Limited by the Ghana Water Company for the 2018 year of assessment. So this is stationery. The first contract was supplied. Now there is one rule. There's one rule in respect of withholding tax. So if you make a contract and the contract is done on a piecemeal basis, maybe you want to engage somebody to supply you or to render services for you throughout the whole year. And because of withholding tax, the contract value may be 2,500. But the law is saying that if the threshold is not met, let's say 2,000 is not, the contract, the payments have not reached 2,000, you will not withhold the tax. So because of this, you want to avoid the withholding tax so that you split the contract. The person has rendered a service for you in January. So maybe you pay 500 cedis. You have not met the 2,000 threshold, so you will not withhold the tax. the same year again, the same year, maybe in April, the person has rendered the same services for you. You pay 1,000. That's 1,500. You have not meet the threshold, so you will not pay. Then September, the person has rendered the same services for you, and you pay 400. That will be 1,900. You will not withhold the tax. In, let's say, November, you have paid the rest 600. The law is saying that if the contract is on piecemeal basis and the contract is relating to the same service, the same goods, or the same works, the tax will be withheld. All the amount will be put together. All the amount will be put together in order to determine the threshold for the same year, unless the contract fall within another year. But for the same year of assessment, if the payment is in relation to the same contract and the payment is done on a piecemeal basis, for the purpose of determining the threshold, we put all the amount together for you. So we put all the amount together so that we get our 2,500. So that we can get our 7.5% withholding tax on it. But the law also says that if, let's say, in making the first payment, 500, and you can believe, or you can base on every information available to you that within the year you will still contact the same person so that the same person will render the same services to you within the same year, and you can believe that, okay, by the end of the year, the threshold will be met. You will meet the 2,000 threshold. So you can start deducting the tax small. So if you are making the 500, you can take the 7.5% out. Then if you're making the next 1,000, you can take the 7.5% out. So that at the time you make the final payment, you'll have what? Taking the tax on all the amount. But if you know that, okay, you don't have every information to believe that by the end of the year, you will meet the threshold, then you can stop. You don't deduct. But when you meet the threshold, then you can what? Then you deduct. Then you deduct.
You do that relative grade on you.
You go and spend the money.
You take it out, and the last one, the person will not come, and the money will be lying in your book.
The person will not come out. The person will not come and render the service again or what?
So he will not supply.
He will not supply.
Mm.
You will still want him to supply before he will not supply.
And it's either you want, and he say he's not having the stock, or you request, and he's not coming.
Okay.
That you have to look elsewhere.
So you have to go to another person.
Yeah,
Right.
I did that, and the money was lying in the account. They came to cite me as preparing improper books.
So then that approach model will not work for you. So don't do that. So you wait. When you meet the threshold, then you did that.
Yeah, but the last time we tried something, and even the least figure will give you that value. So
the least figure will give you the value, give you the tax value.
so you just wait.
Yes, the least value will give you the tax amount that you can deduct from the final payment. So this person, the first contract or in respect of stationery was 1,000 cedis. It was done in January. The same thing, stationery again, 900. It was done in March. This will give you 1,900. Then in August, another 900. So this will give you 2,700. So you can calculate the tax. So the tax will be what? This is stationery. Stationery, what will be the rate? Is it goods or works?
It's good, so
It's good.
So that will be 3%. Is that not it?
yeah.
So just calculate the 3% on the 2,500, and you are good to go. By answering this question, it's 5 marks. Don't come and just multiply and go forward. Explain to the examiner the demonstration I've just did. State the provisions of the tax principle before you do the calculation, so you can get your 5 marks. If you just jump and calculate what amount of withholding tax is due to GRA in the year of 2018. If you just jump and say with 3% multiplied by 2,700, you may get 2. You will not get all the full marks. So state the provisions. Explain more before you do the calculation. Now, tax planning is not in principles of taxation syllabus, but some way, somehow is under Ghanaian tax system. Who is that? Some way, somehow is under Ghanaian tax system. So tax planning is just a taxpayer arranging his tax affairs in order to pay the minimum amount of tax. So you are just trying to exploit the loopholes in the tax law so that you will limit your tax liability. You want to use the loopholes in the tax law in order to pay the minimum amount of tax that you can pay. So there are lots of maxims that they use. So they can use the locational variable, the location.
Time variable.
We can use the time variable. We can use the activity variable or the entity variable. The entity is what type of company do you want to go? Do you want to go into partnership? If it is partnership you want to do, there are tax implications. So you have to know the tax implications of going into a partnership. Do you want to be a sole trader? There are tax implications. Is it a limited liability company? There are tax implications. So you try to know the tax implications of all of them before you venture into the one that will make you pay the minimum amount of tax. Is it the location, the jurisdiction? If it's a locational incentives are there. If you're a manufacturing company, Accra or Tema, there's no rebate for you. You pay the 25%. If you are in other regional capitals, you know the rate. To revise the tax planning maxim. But as I said, this one is in advanced taxation syllabus, and it's there for them. In addition to actis, it's 15 marks. It's 15 marks. Now, because of the tax, you have to know the distinction between tax avoidance and tax evasion. You have to know that. And the possible ways that people involved in tax avoidance and tax evasion. The tax avoidance, that one is legal, but the tax evasion, that one is illegal. So there are tax avoidance strategies that companies use. So the tax avoidance, they may engage in income splitting. They may try to engage in what we call undistributed of profit. And the law says that if you're a company, that the owners are not more than 5, the shareholders are not more than 5, and at the end of the year, you refuse to distribute part of your profit to the shareholders. When you distribute part of your profit to the shareholders, that will be dividend. And that dividend, the 8% tax will be taken out from it. You refuse to do that. You refuse to do that. The owners are not more than 5, and you refuse to do that. The Commissioner General have the power to look at your transaction, take part of your profit as dividend that you pay to the owners, and take the tax of 8%. But the Commissioner General will do that based on all available information to the Commissioner General. You also do that taking into consideration the maximum amount that you can use to defray your operational cost before you declare the other part of the money as dividend to the shareholders. So we have the anti-avoidance rule. We have thin capitalization. You have the arm's length principle. Transactions between related persons must be based on the arm's length. It means that transactions between persons who are in a control relationship must be the same as transactions between persons who are not in a control relationship. So between parents and associate, if there's any transaction between the two of you, that transaction must be based on the market price. That transaction must be based on the market price. If it is even a loan that a parent wants to give to a subsidiary, the loan will be subject to the thin capitalization rule. It means that the interest portion that you can deduct will not exceed the debt to equity ratio of 3:1. So you must know the thin capitalization rule. So if the owner of that company, the owner is a non-resident person, then the company itself or the branch or the subsidiary is a resident company. They will definitely engage in this kind of exchange. The exchange rate sometimes may not be in favor of the resident company. So there may be a foreign exchange lost. The foreign exchange loss too will be subject to the team capitalization rule. So you have to know the rules. So I think I have one question here, which is based on the locational incentives. On the locational incentives. So the Wadawa group of companies has 6. This company, they can give you this question at principles of taxation that you compute the tax payable. The Wadawa group of companies has 6 subsidiaries. They are located in Ghana. These companies include Kardadi Limited. It's a soap manufacturing company situated in what? In Accra, in Greater Accra region. So what will be the tax rate for this company? What will be the tax rate?
In Greater Accra.
25%, is that not it?
Yeah.
Then the second, Kani Limited, is located in Kumasi, specializing in the manufacturing of stationery. The tax rate will be what? 18.75%.
18.75.
Dan Limited is in Winneba. What will be the tax rate? 12.5.
12.5.
Winneba is not a regional capital. The regional capital of Central Region is Kaswa. So that will be
Central Region.
Central Region. Yeah, I say Kaswa out. I for Kaswa is a city on its own. Kaswa is a country on its own. Kaswa is a country on its own. So Central Region is Cape Coast. Winneba is not a regional capital, so the rate will be 12.5. A business in Wa engage in processing of fruits into juice. What will be the tax rate?
Wa? That's enough.
Yes.
2.5.
Oh boy.
Or is it?
5%.
The other northern regions are 5.
This company is not a manufacturing company. You see, the northern regions, manufacturing companies in the northern regions, they don't pay tax.
Okay.
Yeah, but if you are a processing, you engage in agro processing. Yes, you engage in farming business, agro processing. Apart from manufacturing, you pay tax at the rate of 5%. So this company is processing company, processing of fruits into juice. So the rate is 5%. In Charge Limited, located in Cape Coast, primarily involved in cocoa farming. What will be the tax rate? What will be the tax rate?
Cocoa.
Yes. It's exempt from tax.
Exempted, yeah.
Cocoa farming, exempt from tax. Derek, people are fighting at your back or what? The fight should not extend here. Chose Limited, dealing with equipment manufacturing and situated in Tema. What will be the tax rate? 25%, is that not it? All right. So compute the tax payable by each company. So just multiply the profit before tax by the rate. That's all. As a strategic tax planning expert, briefly explain why locating a poultry farm in Wa is more beneficial than locating it in Winneba. What will be your explanation? A poultry farm in Wa, they pay tax at the rate of 5%. But if you locate it in Winneba, a poultry farm, what the rate? Let's talk about farming and agro processing companies. What their tax rate? Accra and Tema, what the rate? 20%. Other regional capitals is 15%. Outside other districts apart from the north is 10%. Then the north is 5%. So if you locate a poultry farm in Wa, you pay tax at the rate of 5%. But if you locate it in Winneba, you pay tax at the rate of 10%. Now let's do question 27 on team capitalization. On team capitalization.
Accra Intema 20.
Yes,
Other regional capitals 15.
yes,
Outside other
other,
regional capitals 10.
yes,
Northern Savannah Ecological Zone 5.
5%, yes. So it's agro processing, farming business, and the rest. That's the rate. Well, let me do this question on think capitalization. So I think this is the last question we are doing. Then I can discharge you to go and justify your inclusion in your exam next week, Wednesday, 9 a.m. to 12 p.m.
Easy.
Charlie, we'll be fine.
Before the book is taller than mountain.
So this question states the provisions underlying think capitalization as a mechanism to combat tax avoidance under Section 33 of Act 896. So the
Question number what?
Question number 27.
Then what you are reading, we are not getting.
I'm reading the requirement too. It's the requirement I'm reading.
Okay.
Yes.
Okay.
Yes. So the think capitalization rule is that if you are a resident company, that your owner is a non-resident person, either the owner alone or with the associate of the owner, they are all a non-resident person. Any loan given to you, the resident company by the non-resident owners, the loan, the interest portion that will be deductible will be subject to debt to equity ratio of 3:1. So it means that
debt to equity ratio.
Yes, debt to equity ratio of 3:1. So it means that the interest portion on the loan or any foreign exchange loss that will be deductible will be what? 3 times the amount of the equity. That is the extent to which you can what? We can allow the interest portion that will be deductible. So why you
before
give,
tax?
Yeah, before tax. Yes, before tax. So why you give a loan? So let's say the equity of the company is 1 million. This is the equity of the company.
Yeah.
It's 1 million. Then the loan that you have given to what? To the subsidiary in Ghana, you're giving the loan of 10 million. And the interest paid on the loan, so maybe 10 million, the loan is 10 million, the interest rate is 20%. So 10 by 20%, what will you get? So the interest will be what? 10 by 2, I think that will give you 200,000, right?
Yeah.
Will it be 200,000?
Yeah, it's 200,000.
It's 2 million. It's 2 million.
The loan is how much?
The loan is 10 million.
Okay.
The loan is 10 million. The interest is 20%. So it means that the interest that will be paid on the loan will be 2 million.
2 million,
So
yeah.
I'm saying that the equity of the company is 1 million.
It's 1 million.
Yes. And the interest that will be paid on the 10 million loan is 2 million. So
it should be shared between the 1 million and the 10 million.
Not only the 1 million. So the law is very, very flexible, you see. So the ratio is 3:1. The equity is 3.
Oh, okay.
The loan is the 1. So it means that the equity will be multiplied by 3. The equity will be 3 times. So the equity will be what? The equity will be 3 million. Is that not it?
3 million plus 10 million.
What plus 10 million?
The loan is a debt.
The loan is a debt, yes. So that's the debt. So the debt to equity. So the equity is 3 times.
Yeah, so it will be 3 million.
It will be 3 million. So the equity will be 3 million. So that'll be 3 by 1. That'll be 3 million. So to know the allowable portion of the interest, which is the 2 million, it will be the equity over the debt multiplied by the interest paid. So that will be 3 million over 10 million multiplied by the 2 million. How much will you get? So that is 600,000. 0.6 million. So it means that the 2 million that you have paid as interest, you can only deduct what? 600,000. You can only deduct 600,000 from your income before you pay tax. So if you don't know, definitely they will deduct all the 2 million before they'll get their profit. They will deduct all the 2 million before they'll declare their profit for tax. So the
But
one
you have to add 1.4 back.
We add the 1.4 million back to your income and tax.
Let's come back to the ratios, senior.
The ratio is 3:1.
3:1. You multiply the equity by
Equity
3.
by 3.
And
Yeah.
then the
debt is the
10
1.
million.
The debt is 10 million, yes.
So multiply by 1.
Yes.
So the total ratio should be 3/11 million.
No, it's multiply. No, it's 10 million by 1. What will it give you?
10 by 1.
Yeah, it will give you 10.
Yeah, it's 10.
Yeah, so it will be 3/10.
So then we didn't factor in the total ratio.
That's
We
the
didn't share
total.
both of them.
You didn't share what? We are not sharing anything, no, senior. The equity is 3. The loan, which is the debt, is 1. So you multiply the equity by 3.
3.
Then you multiply the loan by 1. So if you
So
multiply,
it will be equity over debt.
it will be, yeah, that's what I said here, equity over debt. That's what I said.
Okay.
So it will be equity over the debt.
Okay.
Then multiply by the interest or any foreign exchange loss.
Okay.
So this will be 3/10, 3 million over 10 million. Multiply by
Times
the
2 million.
times 2 million. This will give you 0.6 million. So it means that out of the 2 million interest that they have paid, it is only 600,000 that will be deductible. So in other ways, it means that the company, the foreign owner can give, or the parents of the company, which is a non-resident company, they can give loan up to a tune of 3 million. So when they give a loan of 3 million, it means that any interest that was paid on the 3 million loan will be what? Will be deductible for tax purposes. You see, the principle is very, very clear. If they invest more in the company as a form of equity, the return on the equity is what? What's the return on equity? Why you buy shares in a company, what are you expecting at the end?
Dividend.
Yes, so return on equity is dividend.
Okay, it's dividend. Yeah. Okay.
Yes. And the dividend, we will take 8% tax out of it. Is that not it?
Okay. So they are forcing you to do more equity.
Exactly. We are forcing you because you are not the owner, you are not a resident company, you are not in Ghana. So we are forcing you to do more equity so that so that the dividend you get our 8% tax on it. If they give a loan, the interest, the law is that interest on loan is tax deductible. Is that not it?
Yeah.
If the loan is used to finance the operations of the company, the interest on loan, it will reduce the tax liability of the company. Is that not it? It will reduce that because you deduct the interest before you pay tax. So you will be paying lesser tax. So normally what they want to do is they want to give more loan, so that the interest will be going to them. And the interest will be what? The interest will be tax deductible. So the Commissioner General said, no. If that's the case, the ratio is 3:1. Any interest in excess of 3:1, you cannot deduct it. We will add it back to your income and tax. So come and invest more in form of equity so that your dividends we get our tax on it. So that's the brain behind the debt to 3, the debt to the 3:1 ratio, the team capital. This is what we call team capitalization. So this is what we call team capitalization. Now, one major challenge in exam is how to determine the equity components of the company. You see this question, they give you share deals, they give you revaluation reserve, they give you stated capital, they give you capital surplus, they give you retained earnings. How will you determine the equity portion of the company? That is a challenge. So the equity component always is what? Is the stated capital and the retained earnings, the two items. Share this.
But what of capital surplus?
Capital surplus is the equity. What is capital surplus? Seniors, what you guys I don't do financial reporting.
Is it not SS in share issue that
I'm listening to you.
I think SS or share issue at full market? Okay, no, you can move on.
No, let's know the meaning of capital surplus.
It's like, revaluation surplus or revaluation gain?
No. This one I forget.
That one will
Revaluation
not go to
surplus.
capital surplus.
It's not capital surplus. Share deals is also not capital surplus. They are not equity items. So when they give you, ignore them. Share deals and revaluation reserve. This one, they are out. Don't even include them.
So it's always stated capital and retained earnings.
Capital surplus will be part.
Eh,
Capital surplus will be part, yes.
because we saw some question recently, capital surplus was added.
Yes, capital surplus is part. So capital surplus, but if capital surplus is not there, the major two items, you will see the stated capital and retained earnings. You always see them in questions. But if capital surplus is not there, then the two items is the stated capital and the retained earnings. So capital surplus will be added. So the share deals and revaluation reserve, they are not equity items, so don't add them. They are not equity items, so don't add them.
But when you are dealing with changes in equity, statement of changes in equity,
yes,
revaluation surplus goes there.
Oh yeah, it goes there. Those ones go there, but for taxation purpose, we don't include them. Statement of changes in equity. Share deals will go there, revaluation surplus, capital surplus, and the rest. All goes there, all goes to the equities of a company. But for taxation purpose, we don't include share deals, we don't include evaluation reserve when you are determining the equity for the purpose of team capitalization. No, we don't include them. So stated capital, capital surplus, and retained earnings, the three. That will be the equity component. Share deals and revaluation reserve, no, don't include them.
All right.
So this company, they gave loan. The loan value is what? 1.5 million US dollars. They gave us an exchange rate. The exchange rate is what? One
CD is 15.8.
No, $1 is 15.8.
$1 is 15.8. Yeah.
Yes. So we have to convert the loan to Ghanaian cedis. So what will be the loan value? Are we dividing or we are multiplying?
We'll divide.
Are we to divide? If one USD is equal to 15.8.
No, you multiply.
You multiply. So
you multiply.
So it will be 1,500,000
times 15.8.
Times 15.8. So let me solve this question. I say this is the last question I'm solving.
Team capitalization.
Yes. Then we I think this question 24. What's the name? McDonald Ghana Limited. So the equity of the company is, so the equity of the company is what? Let's calculate the equity. So the first item is what? We have stated capital. How much is the stated capital?
Stated capital is it not share capital? Accepted capital,
Yeah.
150. 150. The third item,
Then
150,000.
the capital surplus. Capital surplus is how much?
Capital surplus is 100,000.
Then
McDonald
McDonald Ghana Limited. Is that not the name of the company?
Okay.
Retail earnings is what?
Retained earnings is 300,000.
So the total equity of the company will be
450? No, 550, sorry.
550,000 Ghana cedis. All right. Now let's get the loan amount. So this will be 15.8 multiplied by 1,500,000 USD. How much are we getting?
The copy CV also.
Don't worry, we're fine. So 15.8 by 1,500,000. So this is 23,700,000 Ghana cedis. This is the loan amount. All right. So the rule, the thing capitalization is debt to equity ratio of 3:1. Debt to equity ratio of 3:1. So the equity,
The loan is where do you get it?
the loan amount is in the question. It's at the top there.
It's 15.8, right?
The exchange rate is a 15.
Okay.
This
Okay,
the
thank you.
the loan is 1.5 million US dollars. The exchange rate is $1 is equal to 15.8. All right. So the equity will be equal to 3 multiplying 550,000 Ghana cedis. How much are we getting? So this is 1,650,000 Ghana cedis. Now, the interest paid. How much is the interest that they have paid? How much is the interest? The interest paid is 200,000 Ghana cedis. The foreign exchange loss is 500,000 Ghana. So the two
So
will be
you add the two.
You don't add, you do them separately. So the interest paid is 200,000 Ghana cedis. So the allowable portion will be equal to 1,650,000 divided by 20,700,000 multiplied by the 200,000. So how much will be the allowable portion of the interest? 1,650 dividing 20700. No, it's 23. The loan amount is 23,700.
Incoming. Allowable portion.
Yes, of the interest. Divided by 23,700 multiplying 200,000. So it means it's only 13,924 Ghana cedis that will be allowed as a deduction. So the disallowed interest will be equal to 200,000 minus 13,924. So 200,000 minus 13,924. This will give you 186,076. So this amount will be added back to the income of McDonald Ghana Limited in tax.
13,124.
So the foreign exchange loss was 500,000. So the allowable portion of the foreign exchange loss will be equal to 1,650,000 divided by 23, 700,000 multiplied by the 500,000. So this will give us 34,810. So the disallowed foreign exchange loss will be equal to 500,000 out of minus 34,810 Ghana cedis. So this will give us 4,65190. So the excess amount, the disallowed amount of 465,190 Ghana cedis will be added back to the income of McDonald Ghana Limited and tax. We've come to the end of the class. Any question? Any question?
I jump.
Hello, sir.
Yes, Sinazulongo.
Concerning the IT in taxation, the information technology,
Yes.
he said you make available some documents.
As I know, I'm also still looking for a senior.
You want to get all the marks?
You want to get all the marks.
Senior, if we collect 2 or 3, 4, 5 B from there to
Oh,
stop.
that place you will definitely collect. You will collect too. Go and use your mind. You will collect senior. The thing is, as of now we don't know what is the contents of that topic because RCAG don't even have the book so that we will know how we will structure the notes. You see, that is our main challenge. That is our main challenge now.
Okay.
So we don't know exactly. I'm putting up some document, but I don't know if that document is relevant to what ICAG want.
Okay.
Yes, but the questions in the pilot questions from ICAG, take note of them.
Yes, sir.
Yeah, take note of them. Take note of them, and you'll be fine.
Yeah.
You'll be fine.
And then, okay, sir. Also, the pensions.
Yeah.
Yes. Can you just walk me through just some brief summary?
The pensions.
Yes,
Okay,
sir.
so the pensions, we have the full pension and we have the partial pension. So the requirement is that, the pension, we have the 3-tier system. So we have tier 1, 2, and 3. The tier 1 is compulsory. The 2 is also compulsory, and the tier 3 is voluntary. So it's compulsory that every employer should deduct 5.5 from a worker's salary and pay on behalf of the employee, then the employer will contribute 13%. The employer contribute 13%. This make up of 18.5%. Now, at the end of every month, the employer will remit 13.5% to the tier 1. Then the 5% to be remitted to tier 2. Tier 3 is the provident fund. That one is voluntary. Now,
Okay.
for the pension, you can, before there are some conditions you have to meet before you qualify for the pension. So one is your age is 60 years. Your age is 60 years. So if you are 60 years before you are retiring, you are qualifying for full pension. This is what you call full pension. So someone who attained the age of 60 before the person retired, full pension. But if you want to retire voluntarily at the age of 55 to 59, you can retire. This is what we call the partial pension. But you will still be entitled to the benefits, the full benefits that you enjoy. You'll still be entitled to it. So there will be some conditions that you may want to retire before the 60 years, maybe due to your health or those conditions. But you must be 55 to 59 before you can retire voluntarily. That will enable you to enjoy the full benefit. Now, how will the benefit be computed? So the computation of the benefits is that first you find the average of 3 years, the 3 years best salary for 3 years best salary of the employee. So before you retire, you look at your salary structure, the three years best annual 3 years best, you find average of it. So if before you retire, they'll take 3 years best salary, annual best salary of you. They add all the 3 divided by 3. That gives the average. Then there's something we call end pension right. Now this will be computed. If you're able to contribute, the minimum requirement is you to contribute for 15 years. If you contribute for 15 years, that 15 years, your end pension right will be 37.5. That Philip, is it 37.5?
Yes, sir.
Yes. So if you contribute for the minimum of 15 years, your end pension right will be 37.5. It means that every year, your end pension right is 2.5. So if you multiply 2.5 by 15, it will give you the 37.5%. The end pension right is in percentage. Now, you can contribute more than the 15 years. So any month or any years in excess of the 15 years, your end pension right will be 1.125% per year. Sina Solomon, I hope you are following me.
Yes.
All right. So any years you have contributed in excess of the 15 years will be, every year your end pension right will be 1.125%. So maybe you are able to contribute for additional 10 years. So maybe you have contributed 25 years in full. That means that the first 15 years will be 30, your end pension will be 37.5. Then the 10 years will be 1.125 multiplied by 10. What will you get?
11.25.
You get 11.25. This will be added to the 37.25 to know your end pension right. So this will be plus 37.25. So your end pension right will be 37.5. It will be 48.75%. This will be multiplied by the average of the 3 years base salary. When you multiply it, whatever the person gets, that is the pension benefit. That's the pension benefit for that particular employee. So if you want to know the monthly pay, just divide it by what? Just divide it by 12. Then you know the amount you'll be taking on monthly basis. Now, Solomon, are you okay?
I'm okay, sir. Thank
Yeah,
you very
so
much.
this is how it's done. But know the three-tier system, tier 1, 2, 3. Then how the pension benefit is computed. You first of all, if you are 60 years and above, that is full pension. You retire before the age of 60, but between 55 to 59, that is partial pension. But you still be entitled to the full pension benefit. So the requirement is to
Then why do
contribute
you call it partial?
because the partial doesn't mean that you will not get the full pension. No. It means that you have not attained the requirement age before you are retiring.
No, if it's not going to affect my entitlement, then it doesn't matter.
Oh, it will not affect. It will not affect. It will not affect your entitlement. It will not affect your entitlement. You still get the full. You still get the full.
That's the same as the early pension, right?
The early pension, yes. It's the same as the early pension, yes. It's the same as the early pension. Now, there's something, so I believe the pension is okay. So you just find, definitely the question will give you the 3 years best salary. Just add the 3, divided by 3. That's the average.
The best salary, is it net salary or gross salary?
Is it what?
The best 3 years best salary, is it the net or the gross?
3 years annual. Annual is it will be the gross. It's the gross. They will not even give you a question for you to calculate the salary. The question will give you straightforward. The examiner will make things very simple for you. They will give you that these are the 3 years best salary of the employee. They will give you, just add them, divided by 3. That gives you the average. Come and compute the end pension right. Multiply it by that. That's all. Let me talk about deemed dividend. So transfer from stated capital to transfer from retained earnings. If you have much money in your retained earnings, and you are transferring it now to your stated capital, it is deemed as you have paid dividend in taxation. So you pay tax at the rate of 8%. The dividend rate 8% to be deducted. Then you still pay 0.5% stamped duty. All right. Any other question? So that we end the class here so that you can go and do the revision on your own. But I'm available. Anything you can let me know before the final day.
Please, sir.
Yes, yeah.
Can you put a figure to the pension this for me to see?
A figure to it for the calculation.
Let's say somebody's average is 140.
That's the average.
Mm-hmm.
You have calculated the average already.
Yeah, it's 140.
Okay, I'm coming. Let me clean the board then. Let me wipe the board then. Maybe we can do that calculation first. The person's average annual salary.
Yeah, it's 140,000.
140,000.
Yes.
He has contributed for how many years?
Let's say 15 years and he is retiring.
Oh, just multiply this one by 37.5%.
Divide by 12 will give you monthly.
The divide by 12 will give you monthly, yeah.
Okay.
So if you multiply this by 37.5, this is the pension benefit for the person.
Yeah.
Annually. So just divide that one by 12 will give you the monthly. Let's say the person contributed for 40 years.
Okay.
If the person contributed for 40 years and the average
25 will be 1.125.
25 will be the total will be 48.75%. The person contributed for contribution for 35 years. Which will be equivalent to what? How many months?
That's 20 years in 1.25.
That is
and then 15 years.
420 months. 35 years is 420 months.
Okay.
So the end pension right So the first 15 years
Mm-hmm.
will be equal to 37.5%. Now,
Times
the rest what? It left with how many years? 20 years, right?
35. 35, you let it 20.
So the rest 20 years will be equal to 20 multiplying 1.125%. So this will give you what?
20 times 1.125. You have 22.5.
So this will give you 22.5%.
0.5 in all 60.
So
You get 60%.
the total will be what? The total
60.
pension, 60
Right.
years,
Mm.
will be equal to 37.5 plus 22.5%. This will give you 60%. So if the average is 140, then the pension benefits will be equal to 60% multiplied by 140,000. This is 84,000. So if you want
84,000 per
80
year.
per year, yes. So
Okay.
the monthly will be 84,000 divided by 12.
7,000.
Which means the person will be getting 7,000 every year.
Every month.
Every month, yes.
7,000 pension, you are better than my active service.
Shall we end the class? Any questions, or we should end the class here?
I think we can contact you whenever we have any decisions.
Oh yeah, sure. All right. I wish you guys the very best in your revision and the very best in the exam. The exam will be very, very simple. The questions will be cheap. You guys will even finish and be saying, Charlie, the questions are easy.
Hey, sir.
Oh yes, the questions will be
Sir,
easy.
please.
ICAG
Sir,
questions.
please, right?
See,
Sir,
yeah.
please. The last time I was trying to get you on the page, but I couldn't find your number. So if you can just write it here for us so that we can just contact you when maybe we need
Go
you.
to the graph. See the graph on the page. You are not on our regular page.
So 05.
I'm on it too, but I couldn't see.
84.
So maybe you should just write it. Thank you.
So this one is on WhatsApp. Okay, all the two are on WhatsApp, or you call 059 305 6705. This one, if you call this one every day, I'll pick. But this one, if you call sometimes, I may not pick. This one, anytime, any day you call, I'll pick. This one. The second one is 059.
I hope they are all on the material.
Okay.
They're
Thank
all
you,
what?
sir.
Yeah, the two are on the material. Yeah, the two on the material.
Okay.
Yes.
All right. Thank you.
All right, yeah. So,
Okay.
yes.
We thank you so much.
I thank you guys too for making the class lively and interactive. So I wish you guys the very best in the exam. The questions will be very simple. ICAG questions are not difficult too. The only thing is the pressure. All right, but we'll be fine. All right, we'll meet some other time. I don't want to meet you. I don't want to meet you guys again. So go and get your pass mark and so that we move forward. We have to clear this exam and do other things.
All right, sir.